So let's talk about market valuation. First of all, to be clear, in the short term, 6 months, 1 year, 2 years, valuation is worthless as a predictor of what stocks are going to do. And in fact, I and others in trying to predict that have gotten into trouble by emphasizing valuation too much. Really, the market in the near term can do anything. But over the long term, 5 to 10 to 15 years, valuation has actually been an excellent predictor of what stocks and other assets will return over the long term. So what I'm going to do today is show you a couple of charts that show us where the market is on a lot of classical valuation measures. And unfortunately, the bottom line of that valuation exercise is that market assets, bonds, and stocks together are priced to yield only about 1% per year for the next 10 to 12 years. So really dismal returns relative to a lot of the past. But let me show you these charts. We have a new Telestrator tool whipped up for us by Kyle Dowley, our technological guru. These charts are from John Hussman, who is a fund manager at the Hussman Funds. If you know John and have followed his work, you will probably also know that he has come under a lot of flack lately because he has been focused on valuation and other measures for a while, and they have led his funds astray in recent years. But you should also keep in mind that often when you are approaching a big turn in the market, lots of folks who are relying on a valuation discipline get ridiculed for many years often and then ultimately end up being proving right. So don't, when you hear the word Hussman, say, oh, well, it's just John Hussman. But these charts are excellent, so I will jump into our Telestrator here. And the first thing I'm going to show you is a chart from 1950 to 2017 of many different valuations. And basically what you see when you look at this is that over time, the market's valuation parameters around many measures, PE, revenue, other metrics, it varies around this central line a lot. And for the first 40 years of this, really until the late 1980s, we were effectively varying around 16 times earnings. Then what we saw is when we got into the tech bubble, we set this huge new level of prices. And one of the things that folks are saying now, as we hit similar levels here, is that, well, you know, the market's still cheaper than it was in 1999 and 2000, so obviously it can go higher. Nobody is arguing that it can't go higher on valuation. There's no question about that. But when you look at what has happened in the past to these valuations, you then find that there is a violent regression to the mean, which is what we saw in first the crash in 2002, and then ultimately the crash in 2009 as well, that brings valuations back to average. And that really pulls down your overall return. So a lot of people, including John Hussman, think that we are going to have a reversion to the mean, even if we say, hey, the early part of this chart had this as a mean, now we have a new mean here. Even if you come back to that, it looks like we have very tough times ahead of us in terms of valuation. So I'll show you one more chart as well. 1950 to 2017. And what this chart is showing you is based on valuations, what the projected 12-year return is of a basket of stocks, bonds, and cash. And what you find is that this is the inverse of the valuation chart. When valuations are low, future projected returns are high, and the red line in this chart, which tracks very closely to the blue line, shows you the actual returns over those 10 years. And so, again, what you see is that in the early 1980s, here, when stocks were incredibly expensive and bond prices and interest rates were incredibly high, we were actually setting up for phenomenal returns for many years. And then what happened is that the market got more and more expensive, we are setting ourselves up for lower and lower returns. And you can see some of the recent volatility here where we have gotten to the point now where assets are so expensive, bonds and stocks, that we are set up for a return of less than 1% a year over the next 10 to 12 years. So you can dismiss that. You can say, hey, it's going to be different this time. Valuation isn't a good tool for this anyway. But in the past, unless it is different this time, this has been a very good indicator of what the long-term performance of stocks and bonds are likely to be. And I should point out that it's different this time has often been referred to as the 4 most expensive words in the English language. So again, you can say that, but you better hope it is different because valuations are that extreme.